Thank you everyone for joining here. We have a really great hybrid event today. So we do have some attending virtually and some attending in person. My name is Megan Shadle from Startup Nation, and I'm really glad that you're all here with us today. I'm joining virtually from Houston, and my colleagues Kristen and Mark are hosting our in-person group in Birmingham, Michigan. So whether you're joining us from online or there in our room, thank you so much for being here. So today's session is called Funding That Fits, How to Find Small Business Financing That Fits Your Business. And we're especially grateful for Nav for partnering with us to make today's conversation possible and for sharing their expertise with our community. We are joined today by two experts from Nav who work with entrepreneurs every day to help make the financing landscape clearer and more approachable. So first we have Nimaj Driscoll, is a business credit and financing coach at Nav and the founder of Driscoll Family Financial Education Services. As a former commercial lender, he now helps business owners better understand how lenders think and how to position their business more strategically when seeking funding. We're also joined by Gerri detweiler, education consultant for Nav, who has spent more than 30 years helping small business owners understand credit and financing. She's answered thousands of credit questions, co-authored 6 books, including Finance Your Own Business, and is widely recognized as a trusted expert in this space. So we're so thrilled to have both of them here with us today. And with that, I'll turn things over to Nimaj and Gerri to get us started.
Thank you, everyone. Welcome to Funding That Fits. And we want to thank our partner, Startup Nation and Verizon Small Business Digital Ready for bringing us here to give this presentation. The Startup Nation headquarters in Birmingham, Michigan are beautiful. So if you're ever in this area, you owe it to yourself to stop by and say hello. Let's talk briefly about the agenda. We're going to first talk a little bit about financing options and what lenders and financing companies typically look for. We will delve a little bit into traditional financing options like the bank loan that you may be hoping you can get at some point for your business. Then we'll go into flexible financing options and resources and next steps. Now, I do want to make it clear that NAV is not providing legal, tax, or financial advice here. We're here to really educate you and open up your eyes to the possibilities that are out there. So then you can take this information and go to your advisors and look into these options and see if they are right for your small business. We really hope you're going to identify some new options that you hadn't known about. And with that, if you want to go ahead in the chat and just tell us what your top financing challenges are right now, that will be helpful as we shape this content and also future content. And again, you can put that in the chat. We'll have a record of this and we'll take a look at what you may be thinking about that's keeping you from getting the funding that you believe your business needs. Every year, the Federal Reserve surveys small businesses, and they ask them questions about financing and funding. And this is some of the more recent data on the type of small business financing that these business owners who participate in the survey say they use. So you notice a credit card is top of the line, followed by loans, lines of credit, trade credit, leases, merchant cash advance, factoring, and then a few businesses don't use any kind of external financing. And that's often typical, but businesses may cycle in and out. So again, we're going to go over these different types of financing and when they might be right for your business and when you may want to look at other options.
And one of the most interesting things that we can see with showing that credit cards are the #1 source of financing used is usually because business credit cards are most accessible. So we'll get into the mechanics of how credit cards work, how they're underwritten, how they support your business as an operation. But credit cards are a great tool and oftentimes the first step on the capital stack for a small business to have access to. All right, so this one is exciting. I love a good X and Y axis, right? So as we can see, financing trade-offs. As costs increases, then we can see the actual financing product is usually going to cost you more if you have lower effort to get it, all right? So the things that are more accessible usually have a higher interest rate or sometimes a structure that you have to really be strategic about before you take it on as a form of capital for your business. And then as you can see, the more effort you put into it, you often have loan products or financing products that come with more favorable terms or often lower costs or lower interest rates. So as we can see, the term loan, microloans, we'll get into all of this later in our presentation. But some of the ones on the higher end of the cost effort matrix are going to be those cash advances that a lot of us are familiar with, as well as like receivables financing. So
yeah, my takeaway here is that the sooner you start looking, the more options you're going to have in the long run because you have the time to put in that effort. Like Nimaj is going to talk a lot about the steps and the qualifications that lenders look for. And if you get that stuff lined up sooner rather than later, you'll find yourself less likely to be in a situation where you just have to take whatever you can get because you need money tomorrow. All right, so speaking of qualifications, let's talk about what lenders and financing companies are often looking for. Again, every lender is different. Each one has its own qualifications, but this will give you some guidelines to think about. The three main top factors that many lenders will consider in some form are revenue, how much money your business is making, and Nimaj will go into detail on that one, time in business. There are quite a few types of financing that prefer at least 2 years in business. If you have a brand new startup business, don't worry, we're going to show you some options. But as you build that time in business, you open up more options in many cases. And then credit. Lenders may look at business or personal credit or both, and we'll touch on that in a moment as well.
Know your industry. So it's really important that you understand what the industry codes are for your business. So the most common classification code is the NAICS, the North American Industrial Classification Code. So this is newer. The industry classification codes actually started with SIC, the Standard Industrial Classification Code. So every type of business there is a certain category that revenue activity falls under. And it's very important because your industry code shows up in a lot of other places other than just your loan application. As an example, if you're applying for business insurance, they look at what your NAICS code is to determine your risk level. So as you can see, risk is something, or risk assessment and categorization of your company is something that follows you in a variety of areas. And I just use insurance as an example, but there's several others. So it's really important to make sure that what is on your business credit report truly aligns with where your revenue is being derived from.
Yes, and you choose this. The government does not assign it to you. These are government codes for tracking purposes, but you choose it. So the census.gov's website, the census that polls people around the country, census.gov, they have a section with a NAICS manual that has the manual. And they also have a service that if you aren't sure which code best represents your business, you can email them and they will help you figure that out. And a quick story on this. Early on, Nav had a customer who was involved in making signs that realtors would put in their front yards when they go to sell houses. He was having trouble getting financing, and it turned out his code identified his business as a real estate brokerage, which it was not. It was a sign manufacturing company. And once he got that switched out, it took a little bit of work. Once he got it switched out, he got different types of financing offers. So this is why we bring it up, because every lender is going to have businesses and industries they prefer to lend into and ones that they don't. So the more accurate is, the more likely you're going to get matched with, lenders that are the right type of lender.
Right. So as you can see, the lens in which you're evaluated, that is exactly what you should start to look at your industry codes as. So moving on to revenue tips, you can't have a business without revenue. As we can see, revenue is one of the main drivers in being able to be approved. So the lender, the financing company, what they're saying is, can you pay me back? Can you prove that you have the capacity to pay me back? So let's dig into it. When we talk about your average monthly revenue or minimum monthly revenue, so oftentimes for small business loans, they're looking around maybe $10,000, $20,000 on average. Now, there is flexibility in this. It also depends on what type of lending partner that you're working with. All in all, it's very important that you run all of your business revenue through a business bank account. So you want to have that separation. So you don't do what, Gerri? Commingle. All right. And beyond that, having all or the majority of your business revenue in one place makes it easier for you to be underwritten versus having some money at this bank, money at this bank, money at this bank, money at this bank. It's hard, you make it harder to identify, where you are as far as that intake goes. Average daily balances. So this is an easy one that a lot of us miss. So making sure that your business can absorb credit, absorb debt, right? So that means having something in your account at all times. So understanding what that number needs to be and having some type of cushion, okay? So that helps, with your liquidity. No more than 3 non-sufficient funds per month. So the lenders are looking at how do you handle your obligations? Is your account running into the overdraft? Are you having, negative balance months? These type of things are, they speak to your financial character and sometimes your financial acumen. So you want to put your best foot forward, and all of these things help you put yourself in a better position. So this webinar today is all about positioning yourselves for financing.
Absolutely. And then the second factor to talk about is credit. And I think we all know credit is a decision factor in many types of lending and financing. Not always. There are some types of finances that we'll talk about that are more geared toward your business revenue rather than your credit. But in that Federal Reserve survey that I mentioned earlier, one of the questions they asked the businesses a few years ago was, when you applied for credit, did you use your personal credit, your business credit, or both? And you can see from the results here that 12% only used business credit, 48% used both, and 40% only used personal credit. So at NAV, we believe that both personal and business credit are important, which is one of the reasons that our services are designed to help you get insights into both your personal and business credit. And we do a lot of tools for building personal credit, but don't neglect or building business credit, but don't neglect the personal credit, because that's also really important.
Mm-hmm.
So we're going to touch on traditional business loans. We're not going to go into great detail here because for many of you, this is not quite where your business is at yet, but we do want you to know what's out there with more traditional loans, like loans from banks, credit unions, and community banks. So the overall qualifications that are often considered in these situations are your credit. Many banks and credit unions like to see good personal credit, and they will check personal credit on owners. And I'll add a quick caveat there. Now, Nimaj is the business banker, but I was at a workshop where there was a panel of business banks, and the audience was made up of small business owners. And somebody stood up and said, "Hey, my business partner doesn't have great credit. Can we apply for a bank loan without checking his credit?" And they said no. Every single bank said no.
Can't get around it.
So if you're going to get a business partner, talk about credit before you decide to do that, just to make sure you know what's going on. They may look for a business plan, not always, but sometimes they, and sometimes having experience in your industry can help you overcome the newer business hurdle. For example, you're a veterinarian, you're going to open your own practice. That would go a long way toward new business funding as opposed to someone who's never tried this type of industry before. They may look for collateral. Personal guarantees are very common. And then, like we mentioned, with the industry, they probably will have industry restrictions. So the sooner you can find out if they lend to your industry and whether that's something they have an appetite for at this moment in time, that will help you get through these qualifications. And then I'll quick touch on SBA loans, because you can just see from the slide, there's so many bullets there. There's so much information about them. We do have a guide at NAV about SBA loans that you can download for free. But the basic concept here is that except for disaster loans, the SBA does not make loans.
Yes.
They guarantee loans. So you're going to individual lenders to get these loans, and you must meet their requirements. And the SBA sets the floor for the requirements, but lenders may go above that floor as long as they don't discriminate on a prohibited basis. So there may be an acceptable credit may be the requirement, and then the bank may have its own internal policy about the credit score that they want to see. SBA loans can be very attractive, and they are designed to get funding to qualified businesses that are having trouble qualifying at traditional financial institutions. So they are worth looking at, but just keep in mind that each lender is a little bit different with, again, following the SBA guidelines. So just because one lender says no, that doesn't necessarily mean you won't be able to get an SBA loan from a different lender.
And Gerri, it's also great to call out that that's an example of the more effort is often going to get you a better quality return or product. So those SBA loans, it requires a lot. It requires paperwork, documentation. So having your ducks in a row, having things in order will help you move through that process with a lot more ease. One of my favorite loan products is the business line of credit. So a revolving line of credit. This is something that most business owners don't have in their business financing toolkit, but can benefit from the most because it helps you borrow what you need at the time that you need it. Okay, so it usually solves a timing issue. So it really helps with cash flow. And to get qualified for a business line of credit, the most important thing that they're going to be evaluating is the consistency and the quality of what? Your cash flow. So you pay it back and borrow again, pay it back and borrow again. So this solves a lot of working capital needs that small business owners, we find ourselves coming up against all the time. It's just like, well, hey, I have a particular client that pays me on a net 60 terms, that pay me a little bit longer than my bills and the things that I still have to be accountable for in between will take. So guess what? If you have a revolving line of credit that allows you to pay for those expenses that are tied to what? Tied to your revenue, tied to your receivables. So when you start to look at financing, everything should be tied to revenue. And if it's not tied to revenue, it may not be something that you need. Now, some of the downsides, there are downsides. These lines of credit do have a draw period and a repayment period. So it's not infinite, okay? So what you want to do is you want to make sure that you manage this line of credit appropriately. So don't draw it all down. So say you get a $10,000 line of credit. You draw down $10,000, you pay on the interest, and then say their draw period is 1 year. So at that time where they renew, if you've never paid that principal down, you might not expect to be able to get renewed or have it again. So you want to have the habit or build the habit of draw down, repay, draw down, repay, of course, in line with your receivables and revenue generation. And then sometimes it can be expensive for long-term financing. So this is really key. So a business line of credit is more of a short-term or a very strategic middle-term product that is tied to your revenue generation to help you smooth cash flow gaps, where long-term financing is best suited for term loans, which we'll get into. All right, term loans. I guess that's a good segue, right? So term loans, as you can see, borrow a lump sum. So this is a one-time cash infusion into your business, and typically you have to pay it back on a term, a fixed term. So in our personal lives, think about it, a car note, a mortgage, those are examples of term loans. So a business, it works the same way. A lot of times the terms are anywhere from 2 years to 25 years. You start to see those 25 years, you get more into the maybe commercial real estate territory, something SBA aligned or whatnot. But the benefits are you have that predictable fixed payment. Okay, so you know what your payment is going to be every single month. So that makes it easy to budget. It helps when you need a larger loan amount. So if you have some expansion, you need to do some renovations, you may need to invest in some equipment, it makes sense to get a term loan because it's going to be on a fixed and predictable schedule. So more predictable interest, which also helps you be better with your accounting. So some of the downsides, once you get that, it can't be accessed again. So access it again in comparison to the revolving line of credit. So once you take that $200,000 loan, when you make your first payment, you don't get that portion back minus the interest, okay? So it's a one-shot deal. And qualifications can vary. So term loans, think term loans, equipment, assets, or growth that may require working capital that is more permanent than semi-permanent or short-term.
So let's shift gears a little bit and talk about more flexible financing. Now, one thing that I discovered when I moved into the world of small business credit and financing more than a dozen years ago was that there are a lot more products than there are in the consumer world.
So many.
We kind of know what they are. And then you go into small business finance, you're thinking, what is that? We do have a lot to cover here. So if we go touch on things lightly, just keep in mind two things. One is that We will be sharing a recording as well as the slide deck with you, so you'll have that as a resource. And then Nav does have a variety of free guides that go into all these topics in more detail. So we'll share those resources with you as well so that you can get the details that you need. But this is a super popular product, and I want to make sure Nimaj gets to talk about it because you're probably going to be offered it.
Ooh, they probably have it.
Yeah, could be.
So that's the reality. Merchant cash advance. So this is literally a cash advance on your business. It's going to be based off of your future sales. Okay, so it's not quite a loan. Think about you are taking the money out of your cash register and paying a percentage of that or a piece of that every day. Okay, so the way these are structured, they're often daily. They can be weekly. It depends on the term. But it can be misused, and if you don't have the right business model, if you don't have enough volume, if you don't have the strategic use for a merchant cash advance, you're going to find yourself in a cash flow crunch and having a lot of pressure to perform. Okay, so as you can see, these come with daily and weekly payments. So it's on that axis we talked about. It's easier to get because it doesn't require a lot of underwriting. So the most important thing is to understand the factor rate is not an interest rate. It performs similarly. So there is some nuance to it. So as an example, you get a $20,000 loan at a 1.4 factor
advance, 20,000 advance.
Excuse me, caught me, right? So advance at a 1.4 factor rate. So essentially what you're paying back is 140% of that. So the 40% is the way to do the quick math. So 20,000 times 40%, what is that? 28,000. That advance that you got cost you 8,000. And there's no benefit in paying it back sooner unless it helps your cash flow, because guess what? You have to pay back that 8,000. All right. So it can work, but it's more so for high volume credit card style businesses or those who can get a rate of return or return on investment quickly. I take that 20, I can make 30 very quickly. Okay, so if you have that, then it makes sense. But if otherwise, then you may want to take a little bit more time to get the right product.
Yes, and if you get payments through PayPal or Amazon, you'll be offered a version of this. They don't go by that exact name, but it's similar. They're basing your advance on your past sales. And I'll give a quick story here just to remind you that you really need to look at the cost. And NAV does have free business calculators you can use to translate that factor rate into an estimated APR. And here's an example. There was an article in Forbes about a woman who was going to buy the hair salon that she was working in, and she got some financing offered to her, and it said stated rate 15%. Well, stated rate isn't really any kind of official term. It's just something that particular financing company made up. And when it was plugged into one of NAV's calculators, the equivalent APR was over, I don't think I've told you this story. Guess what?
This is new to me.
Guess what?
What?
How much?
Over 100%?
Over 1,000%. Equivalent of 1,000%. Not all of them, they're that high. But for you, I want you to make sure that you are understanding the financing that you're looking at.
All right. No, that's a powerful story. So hopefully this helps us make more informed decisions. Invoice factoring, this is another tool in the toolkit. So use these, if you need it. So kind of similar to how I presented a slower paying client. So this is better for B2B style business. If you're doing business to consumer, you really don't have invoices to factor, or it's not as prevalent. But you get an advance on up to anywhere from 70 to 90% of the invoices that you haven't collected on yet. So what happens is you get that money, okay, but the balance is being collected upon by the factoring company. All right, so that's a big thing to know. So what happens is, say, for example, you have and I'll use small numbers, a $10,000 invoice, okay, and they advance you 80%. So that $8,000 that you have access to, they're collecting that other two minus their fees. So you'll get back the difference minus the fees. Now, this gives you a quick infusion of capital. It can help you, manage your cash flow, but just know the trade-off and the credit of the company that you are actually working with is what they're underwriting. So they're not looking at your quality. They're looking at the credit quality of the company in which is paying you. So that's really, really key to understand that nuance. And sometimes it may require multiple invoices to get a deal to be done. So that range could often be between 1% and 4% of the invoice amount. You could compare it similarly to a, APR. So
yeah, and this is very common in certain businesses, certain industries. So if you do find yourself needing this type of financing, it's not something that's necessarily embarrassing. It's in fact, I've worked with some corporate clients, and if you do the same, you will discover the bigger they are, the slower they pay.
That's true.
And also government contracts can take a while to pay. And so I was at a conference where I sat next to someone who all his business does is factor invoices to other businesses that work with Coca-Cola. He knows Coca-Cola is going to pay. He knows they'll pay, but they're going to take their time. And in the meantime, some of the companies that sell to or work with Coca-Cola need their money more quickly. So he steps in and offers that money more quickly. So something to keep in mind if you are looking at B2B financing. Now, we touched on credit cards, and Nimaj is going to talk about the strategy behind credit cards in a second, but I do want to touch on them in terms of financing, because I think a lot of us think about credit cards as a payment tool, as a way to earn rewards. I love my credit card rewards. But they also can be useful to your business in a business capacity. Many of the issuers that offer small business credit cards do report to business credit reporting agencies. And that means if you pay on time and keep your balances low, you may be able to use these to help build business credit. Also, credit cards come with protection under federal law. If they're lost or stolen, your maximum liability is $50. The exception is if you give a card to an employee, once you've authorized it, you've authorized it. So they could go on a spending spree, and I've heard from business owners where this happened, and you could be on the hook. So be careful about that. But they're also potentially a financing tool for your business.
All right. So great segue. Financing tool. Credit cards they should be a short-term financing tool. Now, primarily the best use of a credit card is going to be your dependable monthly operating expenses, your lights, your gas, your insurance payments, those things that your subscriptions, right? Because you know that you have those paid off, within the same period. Because when you introduce financing, you introduce debt, okay? And if you carry over those unpaid balances, then that can put you in a tough position when it comes to qualifying for financing if you have too much outstanding, debt. And it also can, reflect somewhat negatively on your business credit report. So you want to use credit cards in the right way. So credit is a credit line that can be paid in full or over time. You'll also hear in this space charge cards, which are a derivative, is more designed to be paid in full within the statement cycle of the terms that issuer gives you. But that is more of a timing tool and not a financing tool. So it's very important to understand that distinction. So credit cards repayment. You have a minimum payment, partial payment, pay in full. You want to have good to excellent personal credit to be qualified for a business credit card. So this can be, and the strategy comes in is just, well, hey, I have a company that I need, I need to finance something, okay? Well, sometimes you have to lean on the fact that you have stronger personal credit. And it's okay, because that business credit card approval is largely based off of the foundation of your personal credit. So that's nothing to be ashamed about. That's great. That means you qualify for something that you can use. And hopefully the spending that you do on a credit card outside of those expenses are tied to some type of revenue generation in which you can do what? Pay it back. So it could be a short-term financing tool if you aren't eligible for the other types of credit that we talked about, like term loans and revolving lines of credit that aren't attached to a card.
Can I talk about one of the things that I like about credit cards? For the one thing I really like is that you can have a startup business and you may be able to get a credit card tomorrow if you qualify. In other words, the time and business requirement for many of these cards is not there. And what they usually will look at, not always, but often, your income from all sources, not just the business. So it could be personal household income. Maybe you have a partner or spouse who still has a day job and they're willing to pitch in. That can go on that application. And then they'll typically look at, again, as Nimaj mentioned, your personal credit scores. So those are often important. Now, if anyone is watching and you're discouraged because you don't have great personal credit, at NAB, we do have a list of business credit cards that either have more flexible credit requirements or maybe a secured card where you can get the card without excellent personal credit. And that could be valuable in terms of that credit reference that I mentioned. Really look at the interest rate, though, on credit cards because it's often expensive. There are some great 0% credit card offers, usually anywhere from 6 months to as long as to a year. If you pay on time and you pay it off before the 0% expires, then you should be able to take care of that, take advantage of that interest-free period. But if you don't, it's going to be pretty expensive.
So you hear that you have to have strategy in that 0% interest time period, because if you don't, then you're just going to be carrying over quite a bit of debt and a high interest rate. So make sure you use credit cards responsibly.
Yes, and with a personal guarantee. Now, Nimaj, I know you've actually worked in the microlending space, and I love talking about microloans because a lot of they're kind of a best kept secret, right?
Yeah.
Because they're often made by nonprofit organizations, people often don't know they exist. And when they find out, they're very excited. So why don't you explain what they are and how they might be useful?
Microloans, great. So micro, literally small. Small meaning anywhere from $2,000 to about $50,000 is what is categorized as a microloan. Microloans are commonly made by or guaranteed by the SBA, but often, little known secret, nonprofit lenders. So community development financial institutions, also known by CDFIs. So they're here to support, smaller startup micro businesses. So get a micro loan if you're a micro business, right? So they're going to be term loans, all right? They often come with technical assistance. So what is TA? Business support. So being able to have some type of coach or a mentor or resource for accounting or other, business needs to help you manage the capital appropriately so you can grow on to get larger loans outside of this realm. So credit is often going to be a little bit more flexible. Personal credit is still evaluated, so you can't escape it. Got to have, strong personal credit. So this is something we should always be working towards, continuing to build our business credit. Build our personal credit while we're exploring business credit and building those options. And interest rates 0 to 18%. So commonly, I've worked with a lot that were somewhere around 7 to 10%, but that can vary. So.
Right. And another one that we love to talk about at NAV because it has a very personal connection to NAV's backstory. I'll share the story and then I'll let Nimaj talk about more about what they are. You know what? You talk up first about what they are because I think it will make more sense. So.
Yeah. So vendor terms. So when you hear the terms net 30, net anything, net with a number after it, these are vendor terms. Okay. There's vendor credit, there's supplier credit, but it's similar. But nonetheless, you buy now, okay, and you pay by the due date. The date is when those numbers. So if I purchase, some office supplies from an office supply provider, and I spent $500, and I buy that on the first of the month, that means I have 30 days to be able to pay that invoice. So this is a form of credit that is extended to you by the particular vendor or supplier that you're working with. So this is a very powerful short-term cash flow tool. So this is another way where you can control your cash flow without resorting to a credit card, or a charge card, or even a revolving line of credit. So I really love once you are able to get these opportunities that you use them strategically so you don't have to resort to putting everything on a credit card. And it doesn't show up the same way, but they commonly report to business credit bureaus. So this is a great way to build your business credit report because a lot of the vendors or suppliers that offer net payment terms do report your payment history. So personal credit checks are not always common. So that can be a benefit. And many require an entity to be together, your time in business, and having some type of visibility as far as a business credit report. So costs, no interest. So think about it. That same scenario, you do that with a credit card, you're exposing yourself to debt, you're exposing yourself to interest. But if you use a vendor terms, payment terms, net payment terms, then you can still pay that and, it can just give you a little bit more flexibility. And you might get a discount if you pay up front. So that's important too. You pay early, which can influence your credit scores for your business also.
Yeah, and if your goal is to build business credit, do check that they report. NAV has a vendor marketplace, and we share information like that with business owners so they can make decisions about what vendor terms might be best for them. But let me quick tell the story. So Nav was co-founded by Levi King. His first business was sign manufacturing in rural Idaho. Started in his 20s, and he was raised like many of us that debt is bad, don't go into debt. So he had no credit history whatsoever. And cash flow was always a challenge. I mean, he would tell stories of, you know, he would have to spend money on the concrete or the plastic or the labor to put in a sign, and then go try to collect from the customer. And he talks of often putting on his best suit and trying to go to the customer to see if they would pay him, and then running that check to the bank to try to get them to cover payroll. And when finally one of the vendors said, you know, you can probably get credit terms, and set him up with those credit terms, it was absolutely game-changing for his business, because now he could do that work, invoice the customer, and start paying more often out of cash flow instead of out of his own pockets. And so this made it much easier for his business to grow. So whatever industry you're in, there's probably some kind of vendor that can supply something that your business needs, even if you work from home and you need Keurig cups for your coffee machine, or janitorial supplies, or shipping boxes, or shipping labels, business cards, all those kinds of things. And again, Nav does have some great resources. So don't overlook this. It's one type of financing. It's not going to give you a big deposit into your bank account, but it can help you improve your cash flow.
Cash flow tool.
So let's touch on crowdfunding real quick. Let's see, we have about 25 more minutes. We do want to leave some time for questions. So I'm going to go over these parts a little bit faster. Again, you'll have resources afterwards, but just go ahead and put in the chat while Nimaj and I grab a drink of water. Put in the chat, what are the 4 main types of crowdfunding? And Megan, if you get any answers, maybe you can weigh in and tell us what people are guessing for crowdfunding.
No guesses so far. Oh, charitable rewards, debt and equity, GoFundMe, something similar to syndication.
Okay, good. It sounds like someone knows their crowdfunding stuff, because I heard some good answers in there.
Friends and family.
Friends and family, yes. So the main 4 types are rewards. That's like a Kickstarter where you offer something tangible, you know, back my campaign and you'll get the first product, or you'll get a t-shirt, or whatever it may be. Investment, this is where it's completely changed the landscape for investing in a business, because before that, the Securities and Exchange Commission rules made it very, very hard to invest with brand new startups where you didn't have a connection and you didn't have wealthy backers. So now there are platforms that let you go online to raise money. There's also debt crowdfunding. One I want to point out for some of you, if you're not familiar with it, is Kiva, KIVA.org. Kiva offers crowdfunding loans in the U.S. up to $15,000 with 0% interest and no fees. It is a nonprofit, and they're just basically supporting business owners through through capital. And so that's something to check out. And then one of the things you do want, the other one is GoFundMe. So GoFundMe is, it's not used that often for business, but it can be. You have a beloved business owner who becomes ill, or, you know, a business burns down, they didn't have enough insurance, that kind of thing. But do check on the type of industry that you're in to see what's a fit. And I'll give you a little quick tip here. There is a website, crowdfundbetter.com, and they have a free cheat sheet that lists all the crowdfunding platforms and who they're best for. So that can be a way for you to get an idea of what might be out there. So the basic premise is, with any crowdfunding, you create a campaign, you market to the campaign. If you get funding, then you fulfill whatever you promised, and then, you know, you get to keep that money regardless. So there's different strategies around it, but a couple of things to keep in mind there, that many of them are startup friendly. It depends on what you're asking for, but often startups can qualify for crowdfunding. But you need a great campaign, and you need people willing to back it. And those are usually going to come first from people you know. So friends, family, and fans of your business already. So don't expect to just put it up. It happens, but don't expect to just put it up and suddenly you have all the money you need. you will put work into marketing it. But you know what? It's work that you would learn to do anyway in marketing your business. I mean, I remember talking to one gentleman who said, yeah, I crowdfund every new product, and not because I need the money, because I want the feedback. I want to see how people are responding to what I'm offering. So it can be very affordable, depending, again, you don't usually have to pay money back with a few lending crowdfunding campaigns you do. With equity crowdfunding, eventually there will be some mechanism to pay back your backers. But don't forget about taxes. It's often taxable, and so you could get the money if you don't set aside taxes, and then you've spent all the money and don't have money for taxes. You do not want to owe the IRS. So keep that in mind if you're considering crowdfunding.
I love that you called that out about the feedback, because that gives you a chance to refine your business model.
Yes, exactly, and your messaging. Yes, so all this stuff fits together, right? It all fits together.
Equipment leases. So these are term loans. Okay, so you're buying a piece of equipment, or leasing a piece of equipment for a certain amount of time. So you have to figure out, well, is this something that I should invest in for the long term? Is it absolutely necessary? Will it last enough, time for where it makes sense? Or if it's something that I more have a short term or less primary need for. So at the end of the lease, you may have the option to buy it. You may have the option to return it or trade it. So it's a good way to preserve cash. It's another cash preserving strategy, a cash flow tool if you make the right decision. So repayment structure. Typically there's a buyout at the end of it, and you're going to get the lease for the equipment, and that's going to be based off of its actual fair market value. Okay. So when it's time to repay or turn it in, then that's going to be adjusted. So these can be flexible. They still underwrite. Okay. But cost may offer a tax deduction, and it could also have certain clauses that you really have to pay attention to. So it's really key to understand why you're choosing to lease versus to finance. And if you choose to lease, just make sure that you're fully aware of what you're getting into.
Yes, and some of you may be thinking, I don't need to lease, I don't need heavy equipment, but even with a home-based business, there's technology equipment, computers, and other programs that are available.
Computers become obsolete quickly.
Yes.
Right? So it may make sense to lease those versus investing in them long-term. Right?
All right, let's touch on grants. I see we have about 15 minutes, so we're going to kind of whiz through this part. I know a lot of you are super interested in grants. So one tip I'm going to give you right now is sign up for Verizon Small Business Digital Ready, because they do have a grant component to their program, and that's something you should definitely take a look at. But grants are basically money that's given by private organizations, the federal government, or state and local agencies in order to advance their goals by assisting small business owners. And so they often are quite competitive, but if you get one, you typically do not have to repay the money. Now, if you're not a nonprofit, it will probably be taxable. So again, keep in mind taxes when you're getting this type of funding. When you pay back a loan, that's not taxable. It's when you don't pay money back that it can become, taxable. And really think about what the grantee, the company or organization that's making the grant, what are their goals? And you're working to tailor it to those goals. So if you put together a very vague proposal, well, I need money for marketing, I'm a good person, I'll do a great job with this, you're not going to stand out the way someone who knows exactly what they need to do with that money will. Now, here are several sources for grants and for searching and finding information about grants. They're on the slide, and you'll get them in the handout as well. And don't be afraid to befriend your local librarian, because they often have local resources, and they're often happy to help you figure out what's available for grants. And NAB does have a small business grants guide that we can share with you as well. Okay, this is the last type of funding we're going to touch on real quick, and then we're going to make sure we have time for resources and questions and answers. Retirement funds. Now, I'm always hesitant at this point because, we do have a retirement crisis in America, and starting a small business is risky. So when you combine taking your retirement funds plus starting a business, you're really taking a lot of risk with your financial future. However, maybe you're in the great position where you had a great job and you did build up a good, solid retirement savings fund, then that might be something that you want to think about. You can't just withdraw from your IRA without causing a potentially taxable event. So talk to your tax advisor. There is a plan called the ROBS plan, Rollover Business Startup, something like that, that you can roll over your money into a dedicated retirement fund, and then you can borrow against that or use that to fund your business. They are kind of expensive. If you don't do it right, they can trigger taxes and penalties. And again, you could be risking your retirement funds. Where I have tended to see these be most helpful is someone who has very healthy retirement funds and they're starting a franchise, for example, where there's already sort of a business in a box. So they're taking less risk because it's not something completely new and, something they would really need to start from scratch. So given all that, we'd like to know what you think. We want to hear in the chat, what kinds of financing are you interested in? Has something piqued your interest? Have you learned about something new that you might be interested in exploring? We'll take a look at those, and then we'll also touch on some resources and go to questions. So the first resource we'll give is NAV. So you can be familiar with NAV, and I'll let Nimaj talk about this.
All right, NAV, what an amazing tool. So NAV, your NAV Prime membership is going to give you insight on your cash flow, but most importantly, your credit reports from all 3 business bureaus, in addition to 2 personal bureaus. So now you can see what everyone else can see about your business, okay? Because your business credit report is public information. It can't be accessed without you having to give permission. So that's important. All in one house, you have these things. Financing insights, so you'll be able to see what you may be eligible for based off of, your cash flow and other assessments. And even your subscription will count as a trade line to help build business credit history. So now you have something on your business credit that supports that you pay your obligations well. So you can just build upon, which plan that you choose, depending on where you are, your comfortability or business cycle. But our build and expand plans are the best plans if you really want to go full speed with getting your business credit journey on track.
And we will have a special offer for webinar attendees. So you will get that. You will see that in the chat as well as in the email follow-up for this. And I do want to mention that everyone's results will vary. So, NAV's products and services do change from time to time. So go to the website to see what's current. There is also a completely free forever plan that will give you some limited information to get started. So if you're just early in your business journey, I like that because I like to see people get in touch with this topic earlier rather than later. I've talked to so many businesses that have been around for 10 years and they don't know they have business credit. They don't have business. They haven't checked business credit, and maybe they haven't built business credit. And then they're surprised because they say, well, I pay my bills on time. Why don't I have good credit? It's because they haven't proactively been involved in the process.
You can't fix what you can't see.
That's a good point. Good point. All right. So we do have a free ebook that helps you get some steps to start your business. You see the QR code there. We'll be sure to share the link with the follow-up as well. And then we want to give Startup Nation a chance to talk about what they do for small business owners.
All right, thank you so much. So Startup Nation, we are really here to kind of be that one-stop shop to help entrepreneurs take that next step with confidence. So just as our great speakers today have talked about all of those next steps for finding the right financing for you, we really want to be that guide for your as early stage entrepreneurs, small business owners. If you have a side hustle that you're looking to bring to that next stage, or you have a small business that you have online and you're looking to now have a brick and mortar, all of those different elements that it takes to kind of bring that business to your next stage. We are here to support you. So understanding, financing options, preparing, to kind of take those next steps as far as, hiring your next employee or finding the right solutions when it comes down to what are the best solutions for the right tax software or anything and everything in between. We really want to be that best kind of guide and support. And we really have an exciting announcement coming in the next few months. So please stay tuned and stay kind of plugged in to startupnation.com for some changes that will be coming that we're really excited about. So we're really happy to have great partners like Nav on board with us to support Startup Nation and extend all of these great resources in all of these different areas that small business owners are needing support and really great tactical resources and knowledge in. And so this is, yeah, great. If you want to scan this QR code to subscribe, we have a really wonderful newsletter that goes out every Wednesday. We plug in some really great articles from our expert contributors that contribute every single week, that range from all different types of topics, from how to, how to get fundraising, all the way to how to find the right kind of insights to keep your employee morale up, but all about having the right resources for those early stage entrepreneurs and practical tools that you can really apply right away. So that is a great resource to sign up for our newsletter. And then we are also partnered, our secondary partner today is Verizon Digital Ready. I did drop some resources in the chat. They do have a really wonderful grant that has opened up as of April 15th. So that grant is for small businesses that you could apply for the 10K grant. That ends at the end of June is when that grant period closes. You do not have to be a Verizon customer to apply. And so it's very easy. You can just scan this QR code, create a free profile. And from there, all you have to do is take 2 quick courses. Those courses range from marketing help to how to like name my business, what's the best naming mechanisms, all things in between. So there's lots of great resources there as well. So you can just think of Verizon Digital Ready as an additional extension of the resources that Startup Nation can bring you. So please feel free to scan that QR code, take a look at those resources for how to kind of join into that application. And fingers crossed, one of these attendees can be that 10K winner. I would be ecstatic for that to happen.
I would too. How
right?
fun.
That'd be amazing. But thank you so much.
Right. Do you want to handle the questions then, Megan?
Absolutely. So we have had some fantastic questions. Thank you, everyone.
While you're doing that, Megan, I just want to say real quickly, thank you. This has been so much fun. It's been so much fun to visit your offices. Nimaj, we've had a good time.
Great place.
Yeah, we've had a good time. We look forward to more partnerships, and we don't know what the big news is, so we have to wait, wait to find out where you're going on. But we love Startup Nation, so we're excited.
Yes, all very exciting things. And we did get one more question. Can we put the QR code back up? So maybe if we can just go one more slide back up. Thank you so much. So yeah, so I'm going to kind of navigate some questions here. So I'll go back from the very beginning. So one of our first questions that we got early on in the presentation was, I have an SBA loan, but no credit card. Should I have both?
Well, I'll give you a chance to answer too, Nimaj. My answer is it could be a good idea to get a credit card, but it depends on your needs and your goals. So a credit card can be useful for purchases because remember, if your card is lost or stolen and compromised, the money is the credit card company's money. You can file a request, a chargeback request or a fraud request. If you're relying solely on a business debit card, just keep in mind the rules are a little different. So if I interviewed a woman who had her business debit card compromised and her bank account was wiped out in several hours. And then she did get the money back, but it took almost 3 months for her to get that money back in her account. Meanwhile, she had bills to pay. I'm a fan of credit cards for the fact that I get rewards, but I understand you may not feel comfortable with it. Maybe your credit is in a different place and you don't want to worry about debt. So Nimaj briefly touched on something called a charge card. And to me, that's kind of the best of both worlds because charge cards are covered by the federal law that protects you in the case of fraudulent use, but then they require payment either daily, weekly, or monthly. So you don't have the same opportunity to run up debt and just make minimum payments for the next 10 years. So look at your goals and your needs.
No, Gerri is right. Charge cards are a great operational tool. So it's not a financing tool, it's an operations tool. So those subscriptions, those costs that you had to, purchase something for an event that you're doing or whatever it may be. As long as you understand what you're swiping on that charge card, it's not going to, well, first off, it can't. It's not structured that way to where it rolls over into the next period. But it's designed just to give you that operational space because what we're tying this to our receivables, our revenue. Okay, so we know, hey, at this point in the month, I'll pay everything back. So that is a safer way to get the feel of using the tool for what it's designed for. Now, second thought is that hey, if you get an SBA loan or go after that, that's great. But you want to know that typically SBA loan is going to be a term loan for the most part. So that's term, that is installment credit, and then you have revolving credit. So they occupy two different lanes. So it's not always an either or, it can be both. And quite honestly, making a strong credit report, you're going to need to show that you can manage revolving credit responsibly as well as installment credit. Both personally and as a business, those things factor as well. Great question.
Wonderful. Thank you for those answers. Those are great. Next question we have is we have some detail here. So been in business for a little bit around 3+ years, 4 LLCs that have some good business credit but can't obtain funding or credit for inventory marketing. Personal credit is fair. What should they do next?
So just to recap, we have multiple businesses. They've been around for a few years, fair personal credit, and haven't been able to receive funding. So this is not so much of a blanket answer because you have 4 different operating companies that have their own set of exposure, own sets of expenses, own revenue and cash flow patterns and things like that. So the question is, if you're seeing the same thing across all 4, then it could be, well, you have to diagnose your operations. So what are you putting into each one of them? Because if they're all just getting, a small portion of you as the business owner, then you might not be optimizing anything. Okay, so sometimes it's the classic case of being busy, and we think being busy equates to actually, being successful, right? So it's hard to give a direct answer to that, but I think the best starting point is to diagnose each individual business to see, okay, do I meet the cash flow standards? Like a lot of the things we talked about in this webinar, how do my bank statements look? Do my tax returns support financing if I'm being evaluated by a lender that looks at that, right? So it's where you're applying to, what you're applying for, what the business does. Is this an industry issue? Is this an experience issue? So just look at those things for each one and sit down and break them all apart. And that'll probably answer your question. And the quickest way to get the outcome you're looking for across all 4 of them is to build your personal credit up. So at least we know that won't be the disqualifier. It's going to be something related to other business factors.
Yeah, and I'll add that, Nimaj is one of Nav's business coaches. He's very good at what he does. So he delves into it directly with business owners. So that is available on some of the paid plans of Nav. And I would absolutely suggest that if that's something you would like to pursue, the business coaching team can help you look at your specific situation to figure out where the gaps may be.
That's great advice. So next up, we have for LOCs, what is the normal draw period?
I think we're talking about lines of credit, the normal draw period.
Draw period. It depends on the provider. So without not naming names, but what most commonly I've seen 1 year, a 1-year draw period. And then there's some banks that might say, hey, well, we have a 5-year draw period. Okay. So that's your length of time to be able to, use and recycle those funds. So make sure that and a lot of this information, if you're looking to get this type of product from a bank, which I recommend, start where you have the strongest relationship. So where your business bank account is, where your personal bank account is, where they have the most insight, go on their website or sit down with the business banker. Usually your bank, if they serve small businesses, they have some sort of revolving line of credit product. And a lot of the larger ones will disclose a lot of their initial criteria that they look at. So you'll know those exact things. So great question.
Perfect. And looking at some questions regarding loans. So are there any loans that are specifically geared towards nonprofit organizations?
Ooh,
nonprofit lending.
There is, but NAV doesn't specialize in it. So we'll have to refer you somewhere else for that one. It's not NAV. NAV works primarily with for-profit businesses.
Okay, got it. And next up, we have, would invoice factoring be a good funding source dealing with insurance companies?
Not following the question.
It could be, okay. I would have to know a little bit more, okay. So what's prompting invoice factoring to be the consideration? Is it that, hey, the insurance companies, pay a little bit slower, okay? So you're thinking, okay, well, I'll sell off a portion of my, future earnings to get some money right now. So you could, but it could be something where a traditional revolving line of credit may be more suitable, right? So it depends on the scale in which you're doing business, the velocity in which you are receiving payments, and just the true cash flow issue. So that's one of those things to where, sitting down with a small business lender, even our coaching team, or working with more of a loan, the lending company. So interview them, okay? Find out what their terms are so you can make a comparison, because the first part is looking at, this is obviously a working capital issue. It's a timing constraint. So we know we shouldn't be considering a term loan. So it's either going to be a line of credit or invoice factoring. So it depends.
And ultimately, these companies want to get financing. They want to make loans because that's their business, right? You want to make sales in your business. They want to make loans or offer financing, but they also want to be paid back. And so it's a trust factor. They have to make sure that it looks like you can and will repay that debt. That's really key for these companies. So that's why a minute ago, I'll put it back up, but we have the guide that NAV has that talks about the, it's not going back to there, but that's okay. The guide that talks about building your business to establish that trust with these companies that may lend you money. And I got the term trust from Nimaj. I was saying legit before, but I liked his better. So I do
Building credit that lenders trust.
Yes.
And with that factoring, also remember too, they're judging the quality of your receivables. So that company, okay? So if you don't have reputable companies, longstanding companies that might be a question mark that are paying you, then, you have more control over being approved based off of your own operation, which would be a revolving line of credit. And instead of paying the fees that come with factoring, the interest rate that you'll pay, or simple interest, or how it's structured, may actually be more beneficial than using invoice factoring. So, strong question.
Great, thank you so much. And we do have just a few more. I know we're a couple minutes over. Are we good for a few more questions? Perfect. Okay, great. Wonderful. All right. And so everyone, if you'd like to stay on and just go through a few more questions. So next up we have, how do we get our non-reporting lines to reflect on our business credit, i.e. QuickBooks term loans, MCAs, et cetera?
I have a lot to say. Gerri, okay. Well, one thing that's really important to know is that business credit reporting is not required by law. Consumer credit reporting is required by law. Fair Credit Reporting Act is one of the laws that makes this happen, okay, in practice. So just because you have been extended a form of business credit, some type of account, relationship, it doesn't automatically mean that those things are reporting, will report, or should report. So it's discretionary, it's voluntary, not mandatory. So it's up to that issuer. So the first thing is, don't be afraid to ask, well, hey, when you do business with a particular company, credit card company, supplier, finance company, do you report? So find out their reporting practices, for one. That way you're not in the dark. And then two, reporting can change. So there's some companies that may have reported, and then they stop reporting. They don't do it anymore. Or some things that do report don't report to all three business credit bureaus. Some may just report to one or two. NAV, we report to all three. So that's a great foundational tool to be able to have our subscription and our network here. But want to add to that, Gerri?
Yeah, the only other thing I'd add is that there is a company called eCredible, and they do have eCredible for Business, which can allow certain accounts to be reported to certain business credit agencies. In other words, they'll do the verification on their end and then submit it to certain reporting partners. But you can't really force, as Nimaj said, force a vendor or supplier to report to business credit. It's really up to them whether they want to report, and some of them just don't want to.
So that's why what you do have on your business credit report is really important. So even if you don't have a ton of trade lines, I'll just use the terminology right, that's okay. It's more about usage and showing that usage history, that pattern, that spending pattern, that payment history, and that's how you build trust with those who are looking at your credit report.
Great. And just for a quick time check, it is 1:05. We have about 4 to 5 more questions left. Just want to give a quick pulse check on that. So one more question that we have here is if a USA business entity is owned by a Canadian, can the business entity get approved for an SBA loan?
Currently, the SBA has tightened its requirements, and it requires 100% citizenship, or, you know what, I have to check on the green card holder. There was a small portion for green card holders, but it's changed recently. That has been updated on the NAV website. And if you just type SBA citizenship guideline, this has been very recent that they have tightened the requirements for SBA loans to be made to businesses owned by U.S. citizens. So you may need to double check that.
Perfect. All right. And then we're just going to cover one more question, everyone. I know we're a little bit over on time. So last one we have here is, do you have any recommendations on how to connect our LLC to get Experian and FICO reports? I heard they're connected, but still can't find my LLC.
Well, let me answer the FICO part. FICO isn't a credit bureau, so you will never have a FICO credit report, at least not currently with what they offer. FICO will be used in partnership with one of the bureaus, so Equifax, Experian, or TransUnion. It sounds to me like what you're saying is that your business has an Experian business credit report, but you haven't been able to access it. If you're going through NAV, the NAV customer support will help you figure out what the mismatch is there. And if you're not, then you'll need to contact Experian directly to see what the mismatch is. However, I will add that it is not at all uncommon. We see this all the time at NAV, that a business will have been in business for a long time and not have a credit report, or have a very low credit score. And it's not because they did anything wrong per se. In other words, there's no negative information reporting. There's just is nothing reporting. And without account history reporting, they can't calculate the credit score. So this is a very, very common scenario. Another quick tip I'll give you for all of you who are watching, who are thinking, I'll start an LLC later, or I'll form a corporation later. What can happen is you can spend your time building business credit as a sole proprietor. Then you form your corporation. You get a new EIN, which you need for the business entity. And then you have to start things over again. So if this is on your radar and you're thinking, you know what, I'm very serious about this business, I want it to be successful, talk to your advisors and consider going down that path sooner rather than later. So when you do that, then you can start building credit in the name of that entity with that entity's EIN, and then, have that for the long term.
You said it all, Gerri. Preparing for opportunity. Mm-hmm. That's what having a strong business credit report will do. So you don't have to get ready when you stay ready, right?
Yep.
Yeah.
That's fantastic. And I know we have a few more questions in the chat, but a lot of them are great questions about NAV and some more additional NAV resources. So we will follow up on those questions with additional links, additional resources, and additional input and advice from Gerri and Nimaj. But thank you everyone so much for joining us today, and thank you so much for all of the wonderful detailed questions. This was a fantastic session, and we really appreciate all the participation. And thank you so much to Nimaj and Gerri for joining us and being our experts today and guiding us through all of the wonderful resources and insights that you shared with us. We really appreciate it. So everyone, we will be sending the recording of this session and some additional resources. So please, you'll receive that over email. So be on the lookout for that. And we really appreciate it, and more great webinars with great resources to come. But thank you so much for attending today, and we hope you all have a wonderful rest of your day. Any last messages or words from our speakers today?
I just want to say thank you again. And we really do hope your business is massively successful. We'd love to know that, any little small part that we can play in that with the information and tools we provided would make us happy.
Sign up for NAV, especially today. Yeah.
Wonderful. Well, thank you everyone so much. Have a great rest of your day, and we will share these resources shortly.